The recent sell-off we've seen in gold, how much of this is forced selling we're seeing in other asset classes that is actually triggering selling within gold?
It's interesting that initially the sell-off that we saw in gold prices had really been driven by investors' need to meet margin calls, and they were turning to high-quality liquid assets to meet those margin calls. And gold was like a likely candidate, especially given that prices had hit 7-year highs earlier this year. So it was a natural asset for many investors to turn to. But most recently, it's really been that broad-based risk aversion that has seen investors rebalancing portfolios, stop losses being triggered, capital being deployed elsewhere, and it's been the dollar that has benefited from safe haven flows rather than gold. So it's that broad risk aversion that's really pressured gold recently.
Which I think raises the question, maybe beyond the near term, is this rally, is this rebound in gold something that's going to continue?
If we look at the gold price action during the global financial crisis, we saw a very similar reaction. Gold was being pulled between safe haven demand, but also liquidity needs as well. And that to and froing continued for almost 6 months. It took until March 2009 before prices were able to hit $1,000 per ounce again. And then it was later on in 2009 where gold prices hit fresh highs. So we think it's very likely we could see a similar price response now, especially given that ETF holdings have been relatively resilient. We have seen some net redemptions over the past few days, but overall it looks like the longer-term trend is where investors will turn to gold as a safe haven, but liquidity needs will be key in the near term.
Got it. I mean, central bank buying was such a big portion of the demand and the price rally we saw in gold last year. How does that factor in now?
Of course, central bank buying was a key factor because when physical markets were a little bit weaker, the floor was provided for gold from central bank buying instead. What we've seen at the start of this year is that central bank buying has continued, but the volumes have been much lighter. So far we only really have data for January, but it shows that many of those major central banks that have participated last year have continued to add to their gold reserves. So it shows that people are still turning to gold in terms of liquidity and as a safe haven as well. But perhaps the physical market is not as strong as it was, especially as key markets such as India and China, the demand has weakened there as well. So that floor really hasn't been tested.
Yeah, you mentioned the dollar earlier in this conversation and the fact that we have seen this relationship between gold and the dollar. Obviously, when the dollar is stronger, it tends to raise carry costs for the commodity. Is that a relationship that remains intact, or have we seen a divergence given the fact that both have been seen as safe havens as of late?
It's been interesting that the key relationship for gold over the past few months has really been real yields. But the longer-term relationship was really with the dollar. So for most of last year, this relationship had broken down. But that relationship has strengthened again over the past few weeks. So we've started to see, as the dollar has benefited from safe haven flows, gold has actually come under pressure over the past week or so. But before then, both were able to benefit from safe haven flows for much of 2019 and for the earlier part of 2020. But at the moment, it's really the dollar that has benefited from safe haven flows. And we think in the near term, the dollar strength will weigh.
Very quickly, Suki, best way for investors to own gold if they want to right now?
We still like gold over the next few months, certainly over the next 6 to 12 months. We think ETFs and futures, depending on what your risk appetite is, what your duration, that would be the best way to hold gold.